Hello, welcome to everyone to this new video tutorial. My name is Antonio Ciotola from Trade System. In this short video, we are going to talk about trading system decay, when the performance of any strategy can exhibit some change in terms of gains, profit, and loss. That's something that unfortunately can occur. It's impossible to think that you have some portfolio of strategy trading system and over years and years the performance, the equity line is always in gain. That's unfortunately just a dream. But that's not the problem. The fundamental question here is how do I understand that probably the performance of a trading system are starting to decay, and when should I take the decision to stop, to froze, switch off, disable my strategy? So you can understand that the stop of a trading system is something similar to the stop loss of every trade, which is also some kind of tough decision because you might take a stop loss too early, so it's a sort of thin stop loss, or too late, and which means you may have a very large loss in your profit or loss. Let's take into account an example. This is a trade system, Australian dollar versus US dollar. This system was created, let me see, somewhere in June 2012. June 2012, that means that from this, so all the trades you see on the right screen of the vertical line are unseen data, so real trading. So it's roughly more or less till beginning of 2015, roughly 100 trades, which are pretty good. So nothing to say about that. Now let's go forward with the date, and let's go, for instance, to April 2015. Now it's calculating. The performance is starting to decay. Let's go to nowadays, the 2-day date, August 2018, and we discovered that for this strategy, that for this trading system, there is a very deep drawdown here. Well, now it's recovering. Well, there is a phase, a run-up of the equity line, so some of the losses have been recovered. However, you may argue, say, well, I know that is a very large drawdown, but because of this recovering, I can just ignore everything and wait for recovering of the trading system. That's really not very wise decision. It's like you say, hey, I want to ignore the stop loss for my trades because you never know. Maybe there is some kind of recovery. So it's not very wise. So decision is how to stop, when to disable my strategy. There are many approaches for that. You may have a look to the past historical drawdown, or even let's say the max Monte Carlo drawdown with a 95% of percentile. However, in this video we want to discuss a different approach, some kind of quantitative approach, statistical approach, where we have a look to a so-called statistical significance test, or the t-test, or student's t-test. Specifically, we want to have a look to the average trade of the last n trades. I mean, when we have a look, in this case, I am operating with, let me see, I can't remember off the top of my head, with mining lot. We have 5 pips of slippage for any trade. If we just have a look to the statistical average trade, is more or less meaningless in this case. what we want to see is the average rate of the last end trade. However, with this, in one problem with this indicator is that for some markets such as stocks or stock indices, you may have an upward bias, which means the average trade will increase over time. So that makes much more difficult to identify the abnormal values of the indicator. To solve this issue, it's important to divide the average rate of the last end trades by the volatility of the markets. We take in this case an ATR average true range, and we get some kind of signal to noise ratio. So in this case, the noise is reduced. However, how do I know that the change in the value of the indicator are meaningful or less? I mean, some fluctuation in the indicator's value we need to expect, but the question is, how much change must occur before I take an action? To answer this problem, as I said, when we consider the moving average trade, we run the so-called t-test. So let's say you can estimate the value of the average trade for a sample of population such as the list of all historical trades. Then you perform a t-test over the last end trades to determine the probability that these most recent trades are part or not of a sample population. Now this indicator has been programmed to change color from red to green when there is some kind of overperforming or underperforming. The change in color, which has been coded here, it says that basically the t-test is telling me something very important, that there is the probability that the most recent trades are not part of the sample population. They are showing some fundamental change compared to the past, which means you may want to evaluate the performance of the trading system and maybe to allocate less capital, less risk on this trading system. Let's see in practical. So let's move the date. We are now to today date, and let's say we go to April 2015. We notice that the performance were starting to decay in beginning of 2015. Let's see if there is any change to my indicator, which again, I repeat, is an average trade normalized by the volatility in ATR, and we run a test over the last end trades. If we compare these results with a sample of all the trades. Yeah, interesting. You see here there is some normal fluctuation of the indicator, but starting from a certain date, you see the color green for the average trade 7971 in the date of 29 January 2015. So in other words, at the end of January 2015, my strategy is showing a fundamental change, which means for me the decision either to disable the strategy or for sure to allocate less capital. So let's have a look. What my indicator is telling me is that in this date, let's see here, this is April, here, roughly around the trades number 326 is telling me, hey, either you disable this strategy or for sure you should decide to allocate less capital. And I think it's a very wise decision. So let's remember these trades, 326, and now let's move the date to today date. calculating again. 326. So according to my indicator, the strategy should have been disabled in the trade 326 here. So which means you are saving a lot of money in this very long drawdown here. Again, you may argue, say, hey, but there is some kind of recovery of these losses, but that's not the wise approach. I mean, even if there is, first of all, you never know if the recovery will occur or not, first of all. In this case, yes, you're lucky, but that's not, unfortunately, that's not the standard. Second, you might wait for months or years for the recovery. So the question is, why don't allocate your capital over another strategy that is very, very well performing rather than waiting for that? So this is a typical psychological mistake is done. Well, I want to wait because I want to recover my loss and stuff like that. It's really, really not it's not a very good advice. So in this video, I wanted to discuss with you this quantitative approach where we have a look to the average trade normalized by the volatility, and we run this significant test. If you want to know more about all this information, please have a look to my website tradesystem.net. And if you have any question, or if you want to know more about this statistical approach, do not hesitate to send me email. I will be happy to answer you. Thank you very much for your attention for this new video, and hopefully to see you very soon. Bye bye.